Every collapse looks obvious in hindsight, but while it is forming, it always looks impossible. Right now, the global financial system is once again standing at that dangerous intersection, where numbers still make sense on paper, markets still function on the surface, and confidence appears intact. Yet underneath, the foundations are under extreme strain. The year 2026 is not being discussed openly as a crash year. There are no official warnings, no countdown clocks, no emergency announcements. And that silence is exactly what makes it dangerous, because the conditions for a systemic break are already in place. To understand why the dollar system is approaching a breaking point, we need to understand how it reached this position in the first place. The modern dollar system is built on debt, not productivity, not savings, not surplus. Debt. Since the early 1970s, when the dollar was fully detached from gold, the United States gained something unprecedented, the ability to expand money supply without a physical anchor. For decades, this power appeared to be a strength. Debt could be rolled over, deficits could be financed, crises could be postponed, growth could be pulled forward from the future, but every advantage has a cost. As the years passed, debt stopped being a tool and became the system itself. Governments borrowed to fund governments, corporations borrowed to buy back shares, consumers borrowed to survive rising living costs, and financial markets learned to expect intervention as a permanent feature. The result is a system that no longer knows how to function without constant support. Today, global debt has crossed historic thresholds. Sovereign debt, corporate debt, household debt, and derivatives layered on top of promises that assume stability will last forever. None of this would matter if growth could outpace obligations, but it can't. Demographics are weakening. Productivity gains are slowing. Energy costs are structurally higher. Supply chains are fragile. Geopolitical tensions are increasing. The math no longer works. This is where confidence becomes critical. The dollar does not derive its power from gold or oil or even military force alone. It derives its power from belief. The belief that U.S. debt is risk-free, that dollars will always be accepted, and that the system will always remain liquid. That belief is now under stress. Foreign central banks are diversifying reserves. Trade is slowly moving toward alternative settlement mechanisms. Sanctions have weaponized the dollar, turning it from a neutral medium into a strategic tool, and that has consequences. Once trust is politicized, it begins to fracture. At the same time, the U.S. faces an internal contradiction. Interest rates cannot stay high without breaking the system, but rates cannot stay low without destroying purchasing power. This trap leaves policymakers with no painless option. Every decision accelerates pressure somewhere else. This is not speculation, it is structural. And when structures weaken, markets search for signals. That is where gold enters the picture. Gold does not predict crashes. It reflects confidence, or the loss of it. When gold rises gradually, it suggests unease. When gold rises sharply, it signals distrust. And when gold reaches record levels like $4,500, it is not celebrating prosperity. It is warning of instability. Gold performs not because economies are strong, but because currencies are weak. This distinction is often misunderstood. A rising gold price is not bullish for the system. It is an indictment of it. And that indictment is growing louder. Central banks around the world are accumulating gold at record levels, not for speculation, not for yield, but for insurance. Gold has no counterparty risk. It does not depend on promises. It does not require trust in policy decisions. That alone should raise questions. Why would institutions responsible for monetary stability be hedging against their own system? Because they understand something the public does not yet fully grasp. The dollar system is stretched beyond historical limits. And systems stretched beyond limits do not gradually normalize. They reset. The year 2026 is not important because of a calendar date. It is important because of timing, debt maturities, refinancing cycles, political constraints, demographic pressure, and diminishing policy credibility are converging. This convergence is what creates crash risk, not a single trigger, but a loss of margin for error. When margin for error disappears, small shocks create outsized reactions, a failed auction, a banking stress event, a geopolitical escalation, a sudden loss of liquidity. Any one of these can act as a catalyst. And when that catalyst hits, markets will not look to stocks or bonds for answers. They will look to gold, because gold is not part of the system. It is a mirror held up to it. At $4,500, gold would not be telling a story of wealth creation. It would be telling a story of currency devaluation, debt exhaustion, and loss of faith. This is the setup, a system overloaded with obligations, a reserve currency under geopolitical pressure, policy tools losing effectiveness, and a silent shift into assets that do not depend on promises. The crash, when it comes, will not feel sudden to those watching these signals. It will feel inevitable. In the next part, we will explore why gold historically explodes before currency collapses, and why it consistently performs when trust in money fails. Gold does not wait for permission to move. It does not respond to press conferences, political speeches, or official reassurances. It responds to something far more fundamental: confidence. And when confidence in a currency system begins to erode, gold reacts long before the public understands what is happening. This is why gold has such a long and consistent record of outperforming before monetary collapses, not after them. To understand this, we must first dismantle a common misconception. Gold does not rise because economies are strong. Gold rises because money is weak. This distinction is critical. In periods of stability, gold often appears boring. It produces no yield. It offers no growth narrative. It lags equities and innovation-driven assets. This is why gold is routinely dismissed during expansions. But during monetary stress, gold becomes something else entirely. It becomes a truth detector. Throughout history, whenever currencies have been diluted, debased, or politicized, gold has responded, not emotionally, but mechanically. This is because gold sits outside the promise-based system. Every modern currency is a promise backed by confidence, enforcement, and belief. Gold is not a promise. It is a final settlement asset. No counterparty, no liability, no obligation attached. When trust in promises weakens, demand shifts towards settlement. That shift always begins quietly. Central banks don't announce it. Institutions don't advertise it. Sovereign actors reposition discreetly long before retail investors react. This is exactly what we are seeing now. Over the past several years, central banks have been accumulating gold at historic rates, not because they expect short-term profit, but because they are preparing for systemic instability. This behavior alone tells a powerful story. Central banks are the architects of the fiat system. If they are hedging with gold, it means they recognize the system's limitations, and those limitations are becoming impossible to ignore. The dollar system is built on perpetual confidence. Confidence that U.S. debt will always be serviced, that liquidity will always be available, and that the dollar will always remain the dominant settlement currency. But dominance creates dependency, and dependency creates fragility. As global trade expands and geopolitical tensions rise, more nations are questioning the wisdom of relying on a single currency system, especially one that can be weaponized through sanctions. This doesn't lead to immediate abandonment. It leads to gradual diversification. Gold becomes the neutral alternative. It is accepted globally. It is politically unaffiliated. It carries no sanction risk. It requires no permission to settle. As diversification accelerates, gold begins to absorb the pressure that currencies cannot. This is why gold often rises before official signs of crisis appear. Markets sense imbalance before statistics confirm it. Another reason gold explodes early is interest rate illusion. Many believe rising rates are bad for gold. In theory, higher yields should reduce gold's appeal. But history shows that during late cycle environments, gold often rises despite rate hikes. Why? Because what matters is not nominal rates, it's real rates. When inflation outpaces interest rates, real yields turn negative. And negative real yields destroy the credibility of savings. In those conditions, holding cash becomes a guaranteed loss. Gold thrives in that environment. Even when rates rise, if they fail to compensate for inflation, gold benefits. This creates a paradox that confuses analysts, but rewards those who understand monetary mechanics. Gold is not competing with bonds for yield. It is competing with currencies for trust. And trust is a finite resource. As trust erodes, gold absorbs it. Another factor often overlooked is market leverage. Modern financial markets are built on leverage. Derivatives, swaps, futures, and layered obligations. This leverage works in calm conditions. But when volatility increases, leverage becomes unstable. Gold, being one of the few assets without default risk, becomes a natural refuge when leverage unwinds. This is why gold spikes during moments of systemic stress. Banking crises, liquidity freezes, or sudden market dislocations. It is not fear driving the move. It is risk reallocation. As institutions de-risk, gold is one of the first beneficiaries. This early movement often confuses the public. Why is gold rising when stocks are still high? Why is gold strong when the economy appears stable? Because gold is responding to what's coming, not what's visible. It reacts to tightening liquidity, deteriorating credit quality, and policy exhaustion, long before these factors hit headlines. This is exactly why gold performs before collapses. It is not predictive in the emotional sense. It is reflective in the structural sense. And when gold reaches levels like $4,500, it is not expressing optimism. It is expressing loss of faith. Faith that currencies can maintain purchasing power. Faith that debt can be managed without consequence. Faith that political solutions can override mathematical limits. Gold does not celebrate growth. It mourns credibility. That is why record gold prices are not a bullish signal for the dollar system. They are a warning sign. A signal that the system is approaching a point where promises are no longer enough. In the next part, we will confront the most misunderstood aspect of this cycle. why $4,500 gold is not a peak, but a signal that the dollar system itself is breaking. To most people, a gold price of $4,500 seems astronomical. It feels like a top, a climax, a point where caution should dominate. But for the world's most sophisticated investors and institutions, $4,500 is not a peak. It is a signal of structural failure, a signal that the dollar system is being tested to its limits, a signal that the rules of money, trust, and leverage are beginning to break. Gold at $4,500 does not tell a story of speculative excess. It tells a story of devaluation, mispricing, and systemic stress. To understand why, we must examine the mechanics of money in a collapsing system. Currencies are promises. They are faith-based agreements reinforced by enforcement, social norms, and institutional continuity. Dollars, euros, yen, none are money in the old sense anymore. They are units of trust, dependent entirely on the belief that institutions will honor obligations and preserve purchasing power. When that belief falters, gold responds instantly. It does not wait for policy approval. It does not consult economic forecasts. It does not need headlines to justify its rise. Gold is a mirror held up to the system. And at $4,500, that mirror reflects a truth most wish to ignore. The dollar system is overextended. There are several reasons why this level is a signal rather than a peak. 1. Debt overload. Global debt now exceeds $300 trillion. U.S. national debt alone has surpassed all prior records, and interest obligations are rising faster than revenue. The system relies on constant refinancing, monetary expansion, and intervention. Gold at $4,500 reflects not greed, but mathematical inevitability. It signals that debt levels have become unmanageable under the current monetary paradigm. When debt overwhelms income and liquidity, gold becomes the only real asset capable of preserving value. 2. Dollar devaluation. Despite appearances, the dollar has been slowly losing purchasing power for decades. The gap between official inflation statistics and real-world experience has widened. At $4,500 gold, the market is pricing in loss of trust in fiat currency, anticipating that central bank interventions, printing, balance sheet expansions, and low rates will continue to erode the dollar's value. Gold, unlike cash or bonds, is immune to these manipulations. Its rise is predictive of future currency weakness, not reflective of current economic growth. 3. Central bank behavior. Institutional accumulation of gold is unprecedented. Central banks are stockpiling gold at levels not seen since the post-World War II era. They are not doing this because they expect short-term profit. They are doing this as insurance against systemic risk. A record gold price is a signal to the market that even the institutions that maintain the system see stress. And when institutions hedge, private capital follows, often in much larger, faster waves than retail investors can anticipate. 4. Market leverage and liquidity stress. Modern financial markets are built on layers of leverage, futures, derivatives, synthetic ETFs. These instruments amplify movement and risk. When confidence falters, leverage unwinds violently, cash becomes scarce, banks hesitate to lend, paper promises lose credibility. Gold, especially physical gold, becomes the ultimate safe asset. At $4,500, gold is absorbing liquidity pressure that other markets cannot handle, serving as a stress valve before the system collapses. 5. Psychological and historical significance. Humans have valued gold for thousands of years. It carries institutional memory that no currency can replicate. Even modern investors, trained to trust digital money, instinctively recognize gold as a refuge in moments of uncertainty. $4,500 is not a peak because the value is not driven by speculation. It is driven by loss of faith. Markets are simply pricing in what they see. Currencies failing, debt overwhelming, and trust eroding. History confirms this. In every major monetary crisis, 1929, 1971, 2008, gold did not reach a speculative top first. It surged before collapse, then surged further as systems failed. 6. Gold as a systemic indicator. Gold at $4,500 tells the world something few admit publicly. The dollar system is fragile beyond repair at current levels of confidence. It signals that conventional assets, stocks, bonds, savings accounts, no longer carry real purchasing power. It signals that debt is unsustainable. It signals that monetary authorities may act, but action can only delay, not prevent, the inevitable reset. It also signals timing. The market is pricing in future volatility and scarcity before it occurs. Gold is not responding to historical events. It is anticipating them, positioning before mainstream awareness. 7. The public misconception. Most people think gold rises after crises, not before. This is the most dangerous misconception. Gold is proactive, not reactive. It moves as trust erodes. It performs as the system signals stress before collapses are visible. At $4,500, gold is not at a speculative peak. It is reflecting systemic signals already embedded in the global economy. Debt overload, currency dilution, political risk, and declining confidence. 8. Why elites? Welcome this signal. Billionaires and institutional investors are not fearful of $4,500 gold. They are strategic. This price allows them to position before public panic, before systemic shortages, and before the collapse becomes obvious. Gold becomes insurance. Gold becomes leverage. Gold becomes a tool to survive the reset while the average investor scrambles. 4,500 is confirmation for those who already read the signals, and warning for those who have not. Conclusion: $4,500 gold is not a climax. It is a warning, a signal, a message from the system itself. It communicates loss of trust in the dollar. It reflects structural debt exhaustion. It predicts systemic stress before markets collapse. And anyone who interprets it as the peak is missing the broader lesson. Gold performs as a mirror to the system, not as a trophy of wealth. In the final part, we will explore the endgame, how the dollar system breaks, what replaces it, and why understanding gold is critical to surviving the reset. Every financial system relies on a single invisible thread: trust. Without it, even the largest, most complex networks of banks, currencies, and institutions collapse. Not because the assets vanish, not because the debts disappear, but because belief in promises breaks. The dollar system, the foundation of global trade for decades, is standing on this fragile thread. And the higher gold rises, hitting records like $4,500, the thinner that thread becomes. To understand the endgame, we must first recognize the scale of the problem. 1. Structural fragility. The US dollar dominates international trade. Virtually every major commodity, from oil to wheat, is priced in dollars. Sovereign debts, corporate bonds, and global financial contracts all rely on the assumption that dollars will hold value. Yet, beneath this dominance lies structural fragility. Debt has grown far beyond sustainable levels. Deficits continue year after year, financed by money creation. Central banks are trapped between fighting inflation and maintaining liquidity. At a certain point, the system can no longer absorb shocks. It no longer matters if policies are well-intentioned. Markets begin to price in loss of confidence, long before official failures are visible. Gold, by design, responds to these cracks. Rising prices signal stress before the collapse occurs, making it an early warning system. 2. The dollar. Under siege, global reliance on the dollar also creates a vulnerability. As nations diversify reserves, engage in trade settlements outside dollars, and build alternative financial infrastructure, the dollar loses monopoly power. When combined with rising domestic debt and monetary expansion, this creates a perfect storm. The currency can no longer maintain its purchasing power without extreme measures. $4,500 gold is a direct reflection of this. It is not a speculative top. It is a market signal that trust in the dollar is eroding faster than official narratives admit. This erosion will not be linear. It will accelerate as institutions adjust positions, liquidity tightens, and market participants scramble for tangible assets. 3. The catalyst phase. All systemic collapses follow a recognizable pattern. Denial. Markets dismiss anomalies. Public confidence remains artificially high. Distortion. Leverage magnifies small shocks. Liquidity becomes uneven and imbalances grow. Intervention. Governments inject capital, manipulate interest rates, or print money to prevent immediate failure. Reset. Trust collapses, markets reprice, and only tangible assets retain value. Gold plays a role in every phase. Initially, it quietly absorbs imbalances. As distortion increases, it reflects risk that paper assets ignore. During intervention, it remains a stable refuge while currencies are manipulated. And in the reset, it becomes the ultimate arbitrator of value. 4. Who benefits and who suffers? In the endgame, those who recognize signals early are rewarded. Billionaires, institutional investors, and central banks are positioning before the public panic. Their holdings in gold, silver, and other tangible assets serve as insurance. The average investor, reliant on cash, bonds, or digitally denominated assets, will feel the squeeze as purchasing power collapses. Markets will reprice violently. Physical assets will become scarce. Premiums on gold and silver will surge. Wealth stored in paper promises will vanish almost overnight. This is not fear-mongering. It is history repeating itself in a new form. Every major monetary reset, from the 1920s to the collapse of Bretton Woods to the 2008 financial crisis, has followed this pattern. Gold does not spike because of panic. It spikes because it represents truth, and truth always surfaces before crises are fully acknowledged. 5. What replaces the dollar system? A collapse does not mean chaos forever, it means transition. Historically, after systemic failures, new systems emerge. Alternative currencies gain traction. Commodity-backed instruments reappear. Tangible physical assets dominate until confidence in new financial structures stabilizes. Gold often serves as a bridge in these transitions. It maintains value while systems adjust. It provides liquidity when currencies fail. It becomes a global benchmark for trust, not a speculative asset, but a foundation for a new order. Elites and institutions understand this. That is why they accumulate gold proactively. They are not predicting the exact collapse date. They are preparing for a probable transition. 6. Lessons for the public. For ordinary investors, the lessons are clear. Trust in currency is not guaranteed. Debt cannot grow indefinitely without consequences. Physical assets, especially gold, function as insurance in times of systemic stress. Gold at $4,500 is a warning, not a peak. It signals the beginning of a structural reset, where those who position early will protect wealth, and those who rely solely on paper assets may experience significant losses. The pattern is simple. Rise in gold, erosion of trust, monetary reset, repricing of all assets. Ignoring the sequence is costly. Observing it can mean survival and opportunity. 7. The end game. Realized. When the reset occurs, dollar dominance diminishes. Inflation or currency debasement accelerates. Real value shifts into tangible, trustworthy assets. Markets recalibrate according to new realities. Gold will not merely retain value, it will define it. Those who understand this are not speculating. They are navigating reality. This is the end game. Not sudden chaos, but a realignment of value, trust, and monetary order. Conclusion. Script ending in CTA. The 2026 crash will not be announced in advance. It will announce itself through rising gold, tightening liquidity, and systemic stress signals that elites are already responding to. $4,500 gold is not the end. It is the signal, a warning and an opportunity. Those who recognize it now can prepare. Those who ignore it may only understand after the system resets. History does not forgive ignorance, and it rewards foresight. If you want to stay ahead of hidden financial patterns, global power shifts, and the forces shaping money itself, like this video, subscribe to Hidden History Vault and be ready for what comes next.